everybody, Frank Chen here with REIClub.com, your link to creative real estate. Today, I got a quick new video for you covering the pros and cons of investing in a crowd-funded real estate deal. Now, like in all my videos, everything I talk about, I include in the description below. Simply click show more and you can follow right along. So for those of you out there who don't really know this, until 2013, the SEC put restrictions on group funding of real estate deals through general solicitation. But due to the passing of the Jobs Act, it lifted those restrictions and really paved the way to the growth of crowdfunding, which is probably why you're starting to see more and more of these crowdfunding websites popping up, such as Realty Mogul, Crowdshare, Fundrise, Realty Share. These sites open up new opportunities for investors to participate in deals that they probably originally weren't able to before on their own. Now, crowdfunding, generally speaking, is just a way of spreading out the risk as well as the rewards among a larger pool of investors. And these websites allow you to buy into these investments in smaller chunks. That makes it a lot more accessible for the average investor rather than, say, having to put an entire lump sum down for one deal or having to fund an entire development from start to finish on your own. Both options very expensive, but crowdfunding helps alleviate that. But what are the overall advantages and disadvantages of crowdfunding? So to get things started, let's talk about some of the advantages. For all my 8-to-5ers out there who want the benefits of real estate investing but just don't have the time, this may be a good option for you. You know, crowdfunding is more of a capital investment and you're a silent investor. You know, again, you're getting all the benefits of investing, you just don't have a say in how the money is allocated. Also, one of the major benefits also is you get to broaden your investment options. You know, rather than say put $50,000 into one deal, you could possibly spend that among 2, 3, 4 deals using crowdfunding and create multiple streams of income. So that's another way of thinking about it. Also, you have accessibility to accredited investors. Some of these websites will even vet their members to make sure that they have the right amount of income, that they continue to fund the deals, because some of these sites have minimums of $100,000. Not everybody can do that. But if you can participate in these networks, you have a possibility of connecting with some of these other highly successful investors, which is very valuable. The next thing is also because most of this is done online, you can track your progress, track where your investment's heading. There's not much of a paper trail. Of course, in the digital era, that always makes things a lot easier, at least for some of us. The next thing too is because you're not managing, you're not landlording, you don't have to deal with tenants, toilets, and trash. Huge relief. And of course, there's lower fees, which means better returns. Some of these websites will provide the removal of the middleman. No agents, no brokerage. You can save on those fees, which definitely adds up across several deals, saving you a lot of money. And of course, depending on who you crowdfund with, you can potentially say goodbye to indefinite holding periods. Unlike the money market, mutual funds, where you get penalized for pulling money out early, for crowdfunding, it's a little bit more flexible, but yet there are still some hoops you got to jump through. But of course, you don't have to wait till 65 to pull your money out. Now, let's talk about some of the cons. Now, most crowdfunding requires a minimum investment. So if you're thinking you can get involved with a few $100 or maybe $1,000, $2,000, you may not be able to participate. Most websites have a minimum of $5,000, okay? One of the other disadvantages, depending on the deal, the chances are you may not see any type of return for a few months, 6, even 12 months, especially if you're investing in one of those development type deals where you just have to wait for it to be built first and cross your fingers that it's going to be a successful deal. But make sure you pay attention to those types of investments. Next one is, if you're a control freak, this is not going to be a good fit for you. And what that means is, you're a silent investor, you're purely putting capital in, and what you're saying more than likely is not going to be heard. Next, lack of liquidity. As the absence of a secondary market, it restricts easy selling for you to get out. So if for any reason you had an emergency where you need to immediately pull this money out, it could be rather difficult depending on the deal. And if it's a deal that's failing going down and you're trying to pull out, more than likely you're not going to find anybody to take over for you, and you could potentially lose all your money in that stake. So lack of liquidity is a big one for some investors. Next one, risk of investment default from real estate developers is higher in crowdfunding than peer-to-peer. Any situation where you have a management company who, whether it's doing good or not, it's going to be a lot harder for you to control it than, say, a peer-to-peer one-on-one where your input is actually being heard and executed. Next, less experienced investors are more likely to get stuck in a crowdfunding campaign that they cannot afford. purely to the fact of lack of due diligence. Many new investors will get blindsided by the amazing appeal of ROI on these websites and just put their money in without really doing the necessary research and homework. And in that sense, you're going to set yourself up to potential heartbreak. So always remember to do your due diligence and your homework to alleviate some of these risks. Next, some companies have trouble finding funding, which is why they're reaching out to crowdfunding as a possibility. But what that means is an underlying tone. It's less business savvy owners, less experience, which maybe indicates that they may have issues raising funding in the future, right? Poor management. So you definitely got to, research the track record for some of these companies. Next, the taxation and regulations of crowdfunding can be difficult for some. Whether you're investing through an entity or sole proprietorship, crowdfunding is relatively new. So we're still trying to figure out the details. Unless you are up to date with these tax laws, this can definitely slow you down. And last but not least, if a company's due diligence process is not extensive enough, so like some of these newer companies that are popping up, it could cause for poor vetting, which is going to allow some of these deals to get through that aren't quality. And you won't know they're bad until you put your money in and it goes down, right? Which is pretty scary. So it all comes down to how much research you put in. Now, overall, guys, crowdfunding real estate, like any investment strategy, it's essential for you to do your homework and research before putting any of your hard-earned cash into a deal. This means looking at the experience, the track record of these real estate developers who are soliciting crowdfunding money from you. Now, don't be immediately fooled by the ROI or the returns. These sites are designed to flash out in front of you so you do put your money in. So don't be distracted by any of the shiny objects and all the promises and guarantees. You got to get down to the numbers, get down to the facts, get down to the details, and assess your risk. Because remember, there is no such thing as a sure thing, especially in real estate. So protect yourself. Again, guys, this is Frank Chen with REIClub.com. Do me a favor if you haven't already. Go ahead and subscribe to our YouTube channel so we can keep you informed when brand new videos just like this are posted. And to stay up to date with what's going on in real estate around your area and around the nation, sign up for our newsletter so we can keep you informed with that as well. Again, guys, thank you so much for your continued support. We look forward to talking to you next time. Take care, good investing, and bye-bye. Hey guys, I just want to say thanks again for watching our videos. Before you jump off, just do us a quick favor if you could. Go ahead and go like our video because it really does help us out. Subscribe if you haven't already. Check out our newsletter, of course. And again, if you missed our videos from last week, you can check them out right over here. Thanks again, guys, and we'll talk to you soon.